Hey everyone, welcome to CoveredCall ETF Investing, your central hub for deep CoveredCall ETF data. And in today's video, we are specifically going into the CoveredCall ETF ALLSTAR tracker, a Google Sheet I've created to look through some funds that are the easiest to start investing in today. Maybe you are new to investing or maybe just new to CoveredCall ETFs in general, but you want to get participating, you want to get your money compounding, and these are funds that I think are a good choice if you are kind of in that sort of headspace. And keep in mind, I'm someone who's been investing in CoveredCall ETFs for a while, and I use this specific strategy regardless. Doesn't matter that I research this stuff and make videos about it. I already implement this strategy, and I'm looking to implement more of it, even though it's at a fairly basic level. But it's I think for the long term, I think it's just a good steady Eddie general strategy to have. So and just keep in mind, I got if you like the info that you see, there's going to be a link in the description below, or the very first comment that you see if you want to research CoveredCall ETFs for yourself from the tracker. And come July, this static info that you currently see is going to turn live. Performance data is going to be live, yield is going to be live, price is going to be live, volume, 32-week high, 32-week low, all that good stuff is going to be live. So keep that in mind as a bonus come July. That is what's happening with the tracker. So with that all being said, let's get into the video. So let's try to answer a question. What are the easiest CoveredCall ETFs to invest in? Especially if you have the tracker, you see this kind of, week after week, every other day after every other day, you see this. And maybe it just kind of looks a little overwhelming. There's just a lot here. Yeah, you see yield. There's over 200 plus funds between the Canadian tab and American CoveredCall tab. But at least on the Canadian side, what are sort of the easiest CoveredCall ETFs to get into? And there are a style of CoveredCall ETFs that I think really suit the needs of people who maybe just want exposure, just get started, get into it, and then figure out if you're not really sure what your goals, your plans are, but you still want to participate, you feel like this is something you want to try out, maybe you just nibble at these funds a little bit, then I think a really good place to start, it is a natural place to start, the all-in-ones. Really solid place. And what these funds basically are is these are ETFs that invest in a host of other ETFs, okay? So you get ETF diversification within inside all of these, and then you get even broader stock market diversification, and they can all, of course, be, I can filter them by yield. Like HYLD, for example, it invests in basically the US stock market in a bunch of Hamilton funds like SMAX and QMAX and some other sector funds as well that are more geared towards the US. There's HDIV, which is kind of half American, half Canadian if you want both in one place, and you still get a great yield. By the way, these two funds have been increasing their distributions or their dividends for 4 times already this year. And yeah, the Hamilton is doing some pretty amazing things with their sector funds and their suite of maximizer ETFs that have covered calls on them, and then of course their all-in-ones, which are HYLD and HDIV. EQCL is quickly, I would say, it probably has the most trendy hype around it right now, mainly because it's gonna do what ZWK, which is this fund right here, cannot do, which is give us, a really awesome yield and also give us, geographical diversification across emerging markets, developed markets, the Canadian market, and the US market. So great diversification there. EQCL just switched out its it had 2 funds that were kind of more that weren't CoveredCall ETFs, so now they've moved 2 fully emerging markets CoveredCall ETFs and an emerging and in a developed markets CoveredCall ETF into EQCL as well. So this yield's about to jump. I suspect it'll be in the 14% range, at 14%. So anyway, so that's where the hype is right now with EQCL, and so much so I've had this on my watch list for many months, and I'm gonna be swapping out USCL for EQCL. EQCL is basically half of USCL anyway, so I get just more diversification for geography, and I still get exposure to the S&P 500, the NASDAQ 100, the TSX 60, and I get a little bit of emerging markets and developed markets as well. And then we have HDIV, which all of its ETFs inside of it are all Harvest sector covered call ETFs. BMAX, again, it invests in all of its own funds, and BMAX has an interesting lineup of covered call funds because it's not just as simple as utilities and energy and financials. Like they have financials, but it's North American financials, or they have worldwide sustainable real estate. Anyway, but so they're a little bit more niche in that regard, but I don't want you guys to confuse niche for like, oh, it's a small fund and I don't like that. No, it's just their approach is a little bit more niche as far as, you know, these other funds that just have, you know, utilities, energy, financials, that kind of thing. But I own BMAX. I really like BMAX. I'm probably going to give it an upgrade in the sense that I'll maybe put a little bit more money towards BMAX because it's just been such a good performer in the good times, and it's just a steady buoy when things go cold in the market and things go down. Then we got a couple of other all-in-ones by Harvest, which are HBIG and HBUY, and basically these just include, it's basically HDIV but with fixed income as well, so bonds. So bonds and everything inside HDIV would be inside HBIG and HBUY. So this would be, you know, it would have maybe 60% of what HDIV has and then 40% of bonds. HBIG is everything that HBUY is, just with 25% leverage. So you get some really solid yields, you get some solid diversification, and if you're happy with, you know, being kind of in the 10 to 12% range for yield, what these funds can do performance-wise is they give you a good yield, and guess what? They'll give you some solid price appreciation as well. Like over the last 6 months, you're up, you know, anywhere from 6 to 10%, and it's so awesome to see that, because if you're someone who's like, you want to maintain your principal but try to live off of your dividends, then these are funds that are more geared towards that, and especially over the past bunch of 1 year to date. Anyway, same thing. You're seeing green across the board. Yeah, the last trading week of May didn't go as well, but that's okay. That's those times do happen. And as we kind of move across, you see that management fees are all 0%. That all this just really means is these ETFs can't double charge. So they're an ETF that holds an ETF. So they can't charge a, you know, for the underlying and this one as well, and double dip. So basically these funds don't charge anything, but they do charge for all their underlying. But at the end of the day, what really matters is the MER. Again, this is just total cost of everything: leverage, trading costs, the management fee, everything all in one place. Then we got portfolio coverage. I tend to, I like anything that's, you know, 50% or under, especially if it's at 33%. I think it has a better chance to participate with what the rest of the market is doing. Again, cover calls drag on price. That's just the nature. To get more yield, you get less price performance out of them, and you get some really solid AUM. Like, look at these. Some of these are approaching, you know, half a $1 billion. You know, I think EQCL newer, but I think it's been putting up some really solid growth over time that we're gonna look at. And naturally, we've got a little bit of leverage. Now, the leverage in of itself helps to maximize the yield and a little bit of and helps to alleviate some of that the drag on price. So that's what leverage is there for, to try to strip away a little bit of what the cover call strategy tends to lack on, which is, you know, pulling the price down. So leverage, good in that regard for that, especially if you're going to hold it long term. If you're going to hold it short term, then it might not necessarily be the best play in that, from that sense. Some of them have some decent dividend streaks. EQCL, ever since its inception, it's been paying out the exact same, especially with some of the older funds here. HDIV, going good. It's never cut a dividend. HYLD did, but ever since that cut last year, it's just been going gangbusters with steady distributions, and this year increasing its distributions 4 times. So we can see month over month, HDIV, HYLD.U, HYLD all rose, their dividends all raised by, you know, almost 4%. And lifetime change, we got 45% going down here. So yeah, for the all-in-one funds, performance-wise, distribution increases-wise, especially the newer funds, they're stable, they're growing. Really good to see. I think the cover call landscape really has come a long way in a short period of time here in Canada. And funds like these are a great way to just get in, and then as you kind of understand your own goals, your own ambitions, then from there you can better identify what you know, do you buy more? Do you buy, or do you sell off? I mean, for the most part, my TFSA is HDIV. Well, the way I'm setting it up for the next year or so is that it's basically going to all be all-in-ones. And I've been involved with CoveredCall ETFs for the better part of, you know, almost 2.5 years now. So in my opinion, going the all-in-one route is just a great way to go. You get the exposure in there, and especially to each sector. So what we can also do is just look at AUM as well. I think that's probably not a bad idea. So we'll go over, get the American side of things out of there, and we'll go to all-in-one. See what the AUMs are. So again, going for, we see a lot of green kind of across the board here. Lifetime, or I'd say year-to-date change, right? 84% for ZWQT, 16% for HYLD. Some of these funds have been around a little bit longer, so they don't have the kind of same explosive growth that, say, maybe a fund like this does. But yeah, I would say, like, again, what we're looking for with AUM is just health. Are they growing? Are they becoming bigger funds? Are they big funds? Do they have liquidity? That's what we want to know. So hopefully you guys all like that little bit of exposure to the all-in-ones, where you can start investing really easily in the cover call space. These are all great choices, but you can always grab the tracker for yourself to look into these in much greater detail. Hopefully you enjoyed that small snippet from the CoveredCall ETF All-Star Tracker. There is a 2.5-hour video on my Patreon that has all of June's content in it. And as always, if you like what you saw with the tracker, you can pick it up on my Patreon. There'll be a link in the description below, or the very first link in the comments that you see. So with that being said, hit all the buttons of like and subscribe variety, and I will see you all in the next video.